Hello and welcome once more to the FT offices. I'm Yuri Bender, Editor of Professional Wealth Management. Our subject today is the European fund management industry and how one small country at the very heart of the continent is stepping up its efforts to promote European investment products. They're doing this not only on home turf, but also further afield in Asia and Latin America. That country, with the huge global reach, believe it or not, is one of Europe's smallest territories, Luxembourg. And I have with me today one of its key spokesmen, Marc Saluzzi, Chairman of the Association of the Luxembourg Fund Industry, a body known in the financial world as ALFI. Hello, Marc.
Hi, Yuri.
Marc, undoubtedly, much of Luxembourg's success in the financial world has been down to the fast incorporation and exploitation of the 1985 UCITS Directive on the marketing of investment products across borders. Do you feel that the new legislation on alternative investments and hedge funds could have a similar impact to the UCITS legislation of several decades ago?
We clearly hope it. The trade-off which is proposed by European regulators when it comes to AFMD is you will be more regulated, but you will get a passport. That's exactly the trade-off that was built into the UCITS directive. And so we believe that AFMD will push the European alternative asset management industry in the same direction, more regulation, but with a passport. And so we believe that on that basis, we can leverage the success story of the UCITS product to replicate that success story in the alternative field.
So if we can quantify this, Marc, if you have 250 billion euros domiciled in managed assets in Luxembourg at the moment, how big can that number go? Can you double it? Can you treble it? What can you do in terms of growth?
This is the ambition. We have today a non-UCITS business which represents 450 billion euros. Out of those 450 billion euros, we have more or less 200 to 250 billions invested into what I would call truly alternative asset classes, such as hedge, real estate, and private equity. And the objective for our association and our fund center is to double that amount in the next 5 years.
So hedge funds are always complaining about excessive regulation and how they have to spend their time filling in forms rather than actually managing investors' money. But do you feel that with this new regulation, there's going to be a bifurcation? Those funds that choose to be regulated, that have that stamp, the European AIF regulated stamp on them, those are the ones that will be able to raise money in Europe and Asia perhaps, and the others won't be able to.
I think that it will all depend upon the appetite of institutional investors for this concept of regulated alternative product. It will come with a better protection for their money, but it will come at an additional cost. If we manage that trade-off between additional protection and additional cost, I believe that there is a big hope for this regulated AIF concept to develop and to become another brand, another global brand like we have with UCITS today.
And that cost, inevitably it will be passed on to investors, the private clients, the institutions. How much will that additional cost be?
Nobody has been able to put a number on that additional cost, and most service providers have been extremely shy at communicating about that subject. Now, what was interesting was that we were in Hong Kong 10 days ago, and we had a discussion with a bunch of local hedge fund managers. One of them told us that from an Asian perspective, to be interested in a regulated AIF, the additional cost that will come with it will have to be below 50 basis points. So I'm not saying that it will be, the threshold, all the number of basis points that will come up with, this regulated AIF concept, but it's just an indication of, that threshold that institutional investors will look at when considering their appetite for a regulated product or not.
So in Asia, where we've heard a lot of talk about the so-called Pan-Asian fund for distribution, which hasn't really happened for one reason or another. The so-called UCITS funds are really well received there. Do you predict a similar reception and appetite for the new regulated hedge funds and alternative funds?
Yes, I believe that we have the potential to make the regulated AIF concept another success story in Asia. I think that one interesting thing is that with the emergence of AIFs besides UCITS product, we might get a clearer divide between UCITS and AIF, and we could, as a result of that, mitigate the concerns of Asian regulators when they look at our complex UCITS. And so as a result of that, I believe that having clearer value propositions attached to each brand, we could have a better marketing and sales impact in Asia.
There's a problem with these regulators, though, isn't there, Marc? Some of them are getting a bit full of themselves. They're like the referees in the football matches. The best ones are invisible, but some of them want to make a name for themselves and outdo their competitor regulators in neighbouring countries. Might this be a problem for Luxembourg, for instance, where they'll see what the other regulators are doing in the US, in Asia, in other countries in Europe, and think, we want to compete with these guys. We want to outdo them. We want our regulations to be stronger. We want them to be deeper. Is this a problem that the regulator will lose sight of what the kind of cooperation that they've been famous for with the industry in the past?
I would say that gold plating is certainly not a long-established tradition in Luxembourg from a regulatory point of view, but it is clear that the CSSF is looked at by many other regulators. One of the reasons being, for example, the success of our fund center, and so that they have, to meet obviously, their regulators' obligations, notably when going through some peer reviews. But what we have been trying to do in Luxembourg for the last 25 years is working basically with the government and the regulators and providing input to them when they design regulations. And I believe that because of this constant dialogue, we are usually getting to a better result. So yes, they are under pressure. But by this constant dialogue, we are making sure that this constant pressure does not translate into things that will upset the interest of our asset management industry. And I believe that for the moment, because of this constructive and ongoing dialogue, we have been able to do it while preserving the interest of investors in Luxembourg funds.
But if we see this modern-day globalized financial world of competing financial city-states almost, Luxembourg, Dublin, Singapore, Hong Kong, Switzerland, is there a case that each of these will be able to preserve their niche, or will we just see a movement of labour and capital between them?
I think that this is a very interesting question. Our Minister of Finance was in Switzerland a few months ago, and at this occasion, one Swiss journalist mentioned the fact that international financial centers and what they represent do not have a voice, in the global, financial services industry and in the global regulatory debate. And I think that clearly when you look at those different financial centers, those city financial centers, the way you call them, we have a lot to do together, to make our voice heard and to explain why, what we bring to the financial services sphere is so important. And what we bring to this financial sphere is the cross-border dimension, which is so important to the global economy today. But that we have not been able to make it heard, and I believe that more cooperation between those financial centers, will be extremely interesting from that point of view. Now, obviously, we compete, to a certain extent for the same business. If you look at some of those financial centers, they have been, large asset management centers, but not always large fund centers. And we see, for example, Hong Kong, because of the potential access to the Chinese market, starting to develop a strategy to become a fund center as well, and that we have to accept. The fund business is not a prerogative of Luxembourg only, and we have to accept some level of competition. And I think that competition between financial centers is good to a certain extent, because everyone is on its toes and has to improve constantly the business environment that they are providing to market participants. So there is a good thing when you talk about competition.
Is there an aesthetic price to this growth?
Okay.
Luxembourg is a historic city, a lot of cultural monuments and buildings there. It's quite an attractive place. But is there a danger that this growth will spur rise of some ugly, faceless, shiny buildings which will really spoil the view for residents such as yourself?
That's an interesting question, especially when it comes to China. You might know that we have already 2 Chinese banks operating from Luxembourg. They have decided to set up their European headquarters in Luxembourg. We have a 3rd bank in the process of doing it. This is CCB. We have already 4 Chinese fund managers, which are operating Luxembourg funds from Hong Kong. But at the moment, we don't see it, in our skyline. And I think that they have adapted to a certain extent to, the overall style of, the Luxembourg city. And they are extremely discreet, and they are not provoking any, negative reaction because of their, architectural style or whatsoever.
Which ties in with the way you see things, a global plan but adapting to local sensibilities.
Exactly, and Chinese people are pretty good at that.
Marc Saluzzi, thank you very much.
Thank you to you.